Are you looking to get ready, be prepared, and transform your financial future? Then you've come to the right place. This is the Get Ready Money podcast with Tony Stewart, where Tony has insightful conversations with financial experts who are changing the way we think about money. Catch up on the latest financial trends and hear practical advice from Tony and his expert guests so you can build healthy habits that work. Be empowered with tips for implementing small changes that can have a big impact on your financial future. So sit back and get ready to hear from today's guest.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm pleased to be joined today by Barry Fisher. Barry is the president and CEO of Blaze & Bear Insurance Services and host of the Protecting What Matters radio show. In this episode, we'll be discussing Barry's insights on how we change the way we think about money and protecting what matters. Barry, welcome to the Get Ready Money podcast. Thanks for joining us today.
Tony, thanks for inviting me.
Yeah, I'm excited. I mean, we've known each other for a long time, but
let's not go down that road.
Yeah, for our watchers and listeners, but there's nothing bad, Barry, let's get started, tell, maybe share with the audience a little bit about yourself. What is your origin story?
Well, so interestingly enough, last week I started my 49th year in the life and health insurance business. And I have no plans to retire. I enjoy what I do. Probably one of the best decisions I made in the long run was getting involved in this aspect of it. Basically, because I'm a serial entrepreneur, and I being an independent life insurance agent, a long-term care insurance guy, I'm my own boss, and I've been doing it like this for almost 50 years now. So it's been great. I grew up in Southern California. But over the years, I've lived in numerous places. In high school, I got moved to Massachusetts. I lived outside of Boston for a few years. I came back to California, graduated from UCLA, got accepted to law school and business school, and just decided again I enjoyed working and being my own boss. And I was done with studying. I'm more of a doer than a student, really. And then you've been in the life insurance industry, health insurance industry for years as well. It's not an easy thing to do. So I had good years and bad years, and I guess my claim to fame is at about 1990 I kind of fell into the wholesale side of the long-term care insurance industry. And by wholesaling, that meant I was an intermediary between the insurance companies and brokers, insurance agents. And it was just, the timing was right. California was just instituting its 8-hour requirement to be able to sell long-term care insurance. I was able to get a course approved in 8 hours. I was one of the first. I wasn't the first, but I was one of the first to get the 8-hour CE course approved for certification to sell long-term care insurance in California. And I used it as a recruiting tool. It was before online stuff. It was before all the whatever correspondence courses even. And it was just, the timing was right. I won't go into all the details, but I've been on boards of national organizations, and I'm an educator, really. I view myself more as an educator than I do an insurance agent, even though the insurance is part of the education. So I was a wholesaler. I sold the agency. I had a national operation. We sold that in 2013 and 2014. I sold the agencies, went off to be a consultant. COVID killed off the consulting business. And then I was sitting around my ranch here in the beautiful Paso Robles area of California one day, and I just said, I got to find something to do. And I decided to go back into personal production. And that has morphed into some new courses as well, but I'm really enjoying working with consumers. But I also primarily work with other financial advisors and property casualty agents who just don't want to sell life or long-term care insurance anymore. And so it's been started as a retirement gig. Now it's become, again, another business that I get to build. So that's my origin story.
Well, that's awesome. And where you and I met was we both served on the California Department of Insurance Curriculum Board, where we helped create the exam outlines and
Right.
continuing education requirements for long-term care insurance, as well as other lines of coverage.
Mm-hmm. Yep. Absolutely. It was fun.
Yeah, and we were able to really make a difference. I just want to back up for one thing because I know this comes up a lot for people. Is could you define the difference between agent and broker?
Yeah. So it's funny. I had this conversation with somebody um, uh, the other day. So there really, as you know, unless things have changed since we were on the curriculum board, there really is no such thing as a life or health insurance broker. A broker, the relationship of a broker, those are property casualty type guys, and they really represent their clients directly. And that's the term of art within the insurance code. Um, Life insurance guys and health insurance folks are agents. So theoretically, we are contractually obligated to the insurance company. But again, we're also independent agents. So we have most of us are at this point. Back when I started 49 years ago, most of us were captive agents. We worked for Metropolitan Life or New York Life, and that was our primary company. But what's happened is most of us who are still doing life insurance and long-term care insurance are independents. And we have multiple relationships, but we're still insurance agents. We're not brokers, life insurance agents, not brokers. Hopefully that made sense.
Yeah, and it helps. And I think for people watching and listening, the other thing to keep in mind too is agents are contractually agents of the insurance company and not of
Correct.
the consumer. And I think these are important because, we use these terms interchangeably, and it's good for
Right.
people to know who's who.
But again,
And
but along those lines, as you well know, independent life insurance agents, who are selling annuities, life insurance, long-term care insurance, we're still obligated to operate in the best interests of our clients. Okay. So even though we have a contractual obligation with the insurance company, we can't, unlike a property casualty broker who can actually accept premiums on behalf of from the client and is a conduit to the insurance company. We don't do that. We can't do that. But in essence, though, we still have an obligation to do what's in our client's best interest, and I think that's an important thing for consumers to know.
yeah, definitely. And there are different rules and obligations for insurance agents. Also, by line of coverage, but there's annuity standards. And, so if you are looking and comparing agents, those are questions that you can ask and expectations that you can have of your insurance agent. And I think you said something that's super important that I want to really emphasize because this is a red flag for consumers. If you are working with an agent for life insurance or long-term care insurance or disability insurance, and they ask you to submit the premium to them, that is a no-no.
Right.
Uh, you know, don't do that. Report them to the Department of Insurance and find an agent because in the life and health side of the business, premiums are always submitted directly to the insurance company
Correct. Correct.
and never make your check payable to the insurance agent.
No, no, absolutely
so,
not.
so those are some good things. So let's jump into long-term care insurance. Why is long-term care insurance really an important part of financial planning?
Well, that's a really good question, Tony. And real, I'll just gonna, put it out there like this. An unplanned for long-term care event destroys people's wealth. And it also destroys other people's wealth. And I'll explain that here in a minute. But Lincoln Financial did a survey last year. Lincoln Financial Group did a survey of, I want to say, about 500 financial advisors and also about 1,000 consumers. And what they determined was 98% of financial professionals reported that clients who needed long-term care typically withdrew funds from their accounts at more than twice the amount that they should be pulling them out of. So the normal withdrawal rate, if you're healthy out of retirement funding, your retirement accounts is generally 5%. The financial advisors reported that it jumped to over 11% for people who didn't have a plan for long-term care, policy and a plan, really. Okay, so it destroys wealth, number one. It limits people's care options. That's number two. And number three, it negatively impacts the informal caregivers who are then required to take care of you. So it hurts your spouses, your kids, and again, and ultimately it destroys their wealth, because anything that you were hoping to pass on, a portion of what they were hoping to pass on to their kids, gets eaten up by these long-term care expenses. So it's a wealth destroyer, basically.
That's so important, because I don't think we're talking about that enough, especially as more Americans are going in, are aging.
Right.
That the problems can become more magnified. So why do you think the financial planners aren't having these conversations? How can we encourage people to have these conversations?
Well, and that's a great question. I think what's happened is nobody gets trained to sell insurance anymore. We're dinosaurs when it comes right down to it. You and I were trained to focus on risk as opposed to investments. So while these financial folks who call themselves but the younger ones in particular, but the folks who call themselves financial advisors, that's a much more transactional business. It's an important business. It's important to help people achieve their retirement planning goals and objectives. But the fact is, if you ignore the risk piece of that client's plan, then it's not a plan. Okay, so I just got off a call with an advisor that I work with in Chicago area, and we were talking to one of his clients, and the biggest problem that financial advisors have when you're dealing with insurance products, you got to do field underwriting. The last thing you want to have your client is have them apply for an insurance policy and have them to get declined, because it goes into the big database in the sky. And then their future choices for insurance risk products like long-term care insurance or life insurance is limited, becomes very, very limited. So this advisor had already done some work with this client, but he knew he needed some help. So he called me in, and I uncovered a whole raft because I asked the questions. Financial advisors don't have generally have a comfort level of asking people about their health and what medications are you taking? Do you have cancer? Do you have diabetes? What's your height and weight? That was the first question I always asked. Women hate that question. What's your height and weight? But the fact of the matter is you got to get that information before you even have a clue of what insurance company you're going to go and look to. You got to do the field underwriting. So bottom line is, even though the insurance companies have tried to make selling insurance, or at least the process of the application process and all that for an insurance policy transactional, the simple fact of the matter is the run-up is not transactional. And then there is all kinds of things that have to happen during the underwriting process. Once you submit the application, that you have to track to make sure the the case doesn't go off the rails. So in essence, it's a different skill set. You buy a stock. You buy an ETF. It's a one and done deal, right? Or you sell it. But with insurance, it's a process. And financial advisors today are just not trained in that process. And that's why I work with a lot of financial advisors, just to help them with that.
Well, I completely agree with you. I think, there just isn't that emphasis on selling insurance and people being trained in insurance. Like when you and I were coming up, like you were talking about, is the insurance companies would train agents, give them a home, send them to class, and help them become professionals. And today that just doesn't happen. So,
Correct.
Let's say you are a financial planner or an insurance agent and you want to learn more, or start having these conversations. What recommendations do you give to the agents you work with?
Well, again, I mean, I think the recommendation is you need to start. It's, insurance is just part of the plan. So whether you're talking to somebody about their succession planning, or whether, for their business, or their estate planning, for their taxes, or their long-term care planning, you need to lay out all the issues. What do people want? What are their goals and objectives? And if we want to stick to long-term care, you ask them, where do you want to receive care? Who's going to provide the care? Do you have all your legal documents in place? Your durable powers of attorney. Okay, if you looked and see what is the cost for long-term care, where you want to receive it. The insurance piece is the last part of the puzzle. Once you get the plan in place, okay, the question then is, how are you going to pay for it? Okay, and now in today's world, what happens is most people do a partial. They figure, okay, I'm getting X number of dollars a month coming in from my retirement money, my 5%, my 4 or 5% withdrawal rate. What do I need to buy in insurance to supplement that for the care I need where I want to get it? And then it's a matter of, okay, which is the best solution? 20 years ago, we basically were one-trick ponies. We had traditional long-term care insurance. Now we have traditional long-term care insurance along with the asset-based solutions, the life and annuity-based solutions. So we have, different vehicles to use today. So, and that's the other thing, And then one of the other things that I'm learning, because up until I think this, but I started working with this group in the Midwest. Well, before that, I did 99% of my business was in California. Well, California is a country on its own, from a product perspective. Well, now that I'm working with all these folks in the Midwest, I'm on this very steep learning curve of all the other stuff that's available to people outside of California. So yeah, I mean, it's a big world out there of product and understanding what to look for, and then figuring out how you could explain it to the client in English so that they understand it. Not insurance. Try not to speak insurance.
Yeah, that's the thing, and I think that's something that's true across the financial services spectrum. Is that we need to remember that we need to talk to consumers with words that they use every day and not expect them to become experts in insurance. When we look at the medical field, and people who've watched and listened to this podcast have heard me say this repeatedly, our doctors don't come in, when they're helping us deal with a condition and say, okay, well, you need to learn everything about knee surgery before you can proceed with it.
Mm-hmm.
They just help you figure out, what you need to know and answer
Right.
your questions. They don't say, well, have you studied up, a knee, knee surgery? It's not a thing.
Right.
Um,
Absolutely.
so, a lot of financial advisors and consumers have heard, of issues in the long-term care insurance industry. We've seen pricing issues. We've seen huge rate increases. How do you see this going forward? Do you see the long-term care insurance industry stabilizing, fixing these issues?
Yeah, I do. I mean, I think let's go back to the traditional long-term care insurance policies that we were selling, basically post HIPAA, because that's really the modern, 1997 and beyond. That's the modern age of long-term care insurance when, the HIPAA, the Health Insurance Portability and Accountability Act, established the standardized benefit triggers, benefit qualifiers, and standardized a bunch of stuff in these policies on a national basis. So those products, basically, I mean, there were pricing issues, and I mean, some of them were self-inflicted wounds by the insurance companies. Others were unintended. The self-inflicted wound, and again, I don't want to get too geeky here, but when you price a policy, when you price any kind of life or health insurance, a long-term care insurance is traditional long-term care insurance is a health insurance product, but it's more like a life insurance product because it stays in for you're expecting this thing to be enforced for 20 or 30 years potentially before you ever make a claim on it, as opposed to the health insurance you buy every year that can be repriced. So it's like the insurance companies back in the late 90s and early 2000s were doing a moonshot. What's this going to look like where are we going to be 20, 25 years from now when this client goes on claim? So the factors that went into the pricing of these policies were interest rates, right? Because about 80% of a long-term care insurance premium on a traditional product is reserved to pay future claims. So a 50 basis point difference in the long-term rate of return on those reserves can absolutely throw off the whole pricing model. Okay. So what happened was so just on that particular thing alone, the insurance companies were saying, we generally make 5 or 6% on our reserves over time. Well, unfortunately, we all know we lived through about a 15-year period of unusually low interest rates. So instead of getting 5 or 6%, they were getting 4 or 5%. So that was a primary issue on the pricing of those older policies. They didn't get so that was an unintended thing that happened to the insurance companies. They also figured the other big thing was lapse rates. Insurance companies assume that a certain percentage of people are going to drop their policies. And when they drop their policies, when they drop them either because they die, an involuntary lapse, right? Or a voluntary lapse. They just decide they don't want the policy anymore. When that happens, those reserves come back into the reserve pool. Well, they assumed a higher lapse ratio than they got, which was also a big impact on the claims, on the rate stability, as it would be called. And the third big thing was they didn't get the claim right. They were dealing with a dementia claims now all of a sudden which were lasting longer than they anticipated. So it was really a perfect storm of bad stuff that happened to the older traditional policies. Now, all that being said, as you well know, each individual state Department of Insurance regulates rate increases. Well, in some of these states, the states didn't want to allow for rate increases more incrementally, so they backed up. The insurance companies, especially at a place like California, I mean, it was a nightmare because they just wouldn't approve rate increases until all of a sudden they realized these insurance companies were potentially going to go broke if they didn't. Kind of similar to what's happening with homeowners insurance in California right now. And that's a whole other topic too. But the whole, so the departments of insurance drag their heels. So ultimately now we've seen all these big rate increases, and people can adjust these policies. What we're finding is that as we get these rate increases in, you get on the phone with the client and you say, okay, you bought this with 5% compound inflation. You probably have more than enough benefits. Let's drop the inflation rider off, or let's drop it down to 3%. So again, the clients should not panic when they get the rate increase letter. They should either call their agent, if the guy's still alive or is still, in the business, or work with the insurance companies to adjust the benefits to keep that policy affordable. In fact, I've got, I won't mention the company, but I've probably got 30 of these, all that are sitting on my desk that I know over the next year they're going to be getting their rate increase letter from the insurance company. And because most of the agents are retired or passed away that used to write the business through my agency, I'm going to be getting on the phone with all these people and communicating with them. I don't want them to drop their policies. It's a very valuable piece of protection that they have. And we just need to figure out how to make it affordable for them. And that's what you have to do. As far as going forward, and I'm probably going on too long for you here, but the newer policies, the asset-based policies, the combo policies, the life and annuity policies with long-term care benefits, those have more guarantees in them. The rate structures are guaranteed. You're paying more, of course, because you're now on a life combo product. You're paying to insure two risks. You're insuring life and long-term care. So the going in premium is higher. But again, you're going to have more rate. There's going to be rate stability because they've built the guarantees into those policies. So yeah, again, the industry is adapting. I think a lot of the business is shifting to the combo products. Um, and so they're very attractive, especially for people that can just reposition some underperforming assets or reposition an annuity. Okay, that they've got an annuity that's an old style deferred annuity. It's out of the surrender charge period. They reposition it into a long-term care, an annuity that provides long-term care benefits, and then they're leveraging it up for long-term care. And the money, when they go on claim, the money that comes out of that policy will be tax-free as opposed to taxable. So there's all kinds of good reasons to look at, especially if people have been purchasing annuities, to repositioning an older annuity to what's called a Pension Protection Act approved annuity, which allows for a long-term care benefit within it.
Well, you covered so many things there, and I think at the end, what you're mentioning is a 1035 tax-free exchange of an old contract.
Right.
And you can also use old life insurance policies.
Yes.
So sometimes if you have these whole life policies that have a really high cash value that you're not intending to use, those are
Right.
a great source to
Yep.
fund a long-term care insurance policy. A couple other things, in terms of pricing, I want to add. One of the things in my mind that I think was a huge mistake on the part of the insurance companies was lifetime benefits instead of a defined benefit pool. Is, when you look at other types of insurance, the company is saying, we're going to insure you for this amount, and this is a maximum amount. And instead they said, well, we'll just pay you for a lifetime, but we have no idea what that's going to consist of. We're
Yes.
just going to guess. Granted, actuaries are not guessing, actuaries are a science, but at the end of the day, it really is a guess because they have no idea what was going to happen. And when we look at other forms of coverage, some of them have 200-300 years of experience that the insurance companies can go back and look at.
Yep.
So they engaged in risk-taking behavior themselves. Now, that doesn't help people going forward, but it's important to understand that, the insurance companies, as you pointed out, are learning from their mistakes and coming up with different products that will hopefully perform better. Although, my concern with the combo products, one, as you pointed out, is that clients are paying for a life insurance benefit that they may or may not need. But with the underperformance of so many life insurance policies, you've taken two products that have had pricing issues and combined them into one product, which means that if you do these asset-based products, is that you do need to keep an eye on them and think about the costs that you're paying. So, sorry, just to give your answer a lot of
most of the life insurance-based combo products are guaranteed now. I mean, they're either guaranteed universal life, okay, indexed or fixed, okay, or it's a whole life chassis. So the risk on the life insurance piece is not, again, the life insurance, not doing the weeds, but I mean the life insurance benefit becomes minimal on those. It's basically used to identify, kind of create that initial pool of money, that initial benefit that's paid out, and then the client pays for an additional continuation of benefit rider to take it past a 2-year type benefit. So yes, which are again guaranteed rates. So they're doing a better job on it. But again, they're representing, current reality in pricing, and not reality from 1995 or 1996. But you're right. Lifetime benefits with 5% compound inflation on riders were pretty disastrous.
Yeah, and who could have seen that coming?
Well, it wasn't priced. It wasn't priced. It wasn't priced right. It just wasn't priced right. So
yeah, well, that's the benefit with any type of financial services, to start off conservatively
right.
rather than aggressively. And that's what happened. The companies got out over their skis. We can talk about disability insurance in the 80s. That's another great example, but we should probably move on from this conversation. But I do want to emphasize one thing that you were talking about. is that there are different contracts. And so it's important to work with somebody who understands the different
Mhm.
alternatives and can
Right.
explain them. So if you're a planner and you're working with an insurance agent, did you understand what the insurance agent is presenting to your client?
Hmm.
And if you're a consumer, the same thing. Ask questions, be curious, make sure that the policy is going to do what you expect it to do.
Right. Absolutely.
There's no guarantees, of course, but
Yep.
you
Yep.
can definitely ask questions. So Barry, before we get into the fast round of questions, you're also working on business valuations.
Mhm.
So, just real quick, and I think this is becoming pertinent, as, baby boomers are starting to sell their businesses and everything is age. Why should people and businesses consider getting a business
Right.
valuation?
Well, just by way of, again, historically, my first love in the insurance business was working with small business owners, owners of closely held businesses. I won't say small, but closely held businesses. Because again, of my entrepreneurial spirit, I guess. And one of the big aspects of doing that is helping people with their succession planning. You got a couple of partners, or you have somebody you want to pass your business on to your kid, okay? Or you want to sell your business, but all those things, estate planning, the business is a big piece of most entrepreneurs' asset base. Now, 72% of business owners say they plan to sell their business, okay, and use that to fund their retirement. But only 2% of business owners know what their business is worth. So when I restarted personal production, I was really focusing on the business owner market. And I started talking to people, and you'd say to a business owner, well, okay, you need to do the succession planning, you need to do your buy sell agreement. So you don't end up with in business with your partner's wife or spouse, okay, that you have money there to buy them out of the value of the business. We need a buy sell agreement. Okay, what do you think your business is worth? And people would look at you like, I have absolutely no idea. So along that path, I discovered an online business valuation service called BizEquity. And they market specifically to financial advisors and insurance agents who are in this market space. And again, I won't go into all the details, but it's all online. It's driven off of the tax returns. It's a really cool program. It's not a certified valuation, but it's a credible valuation. The company's run by business valuators. It's a really cool tool. And so what I do is I talk to a client and I'll say, listen, if you don't have an idea what your business is worth before we even start talking about the succession planning stuff or the key person stuff, we need to do a business valuation for you. We need to figure out what your business is worth. And with 3 years of tax returns and some other minimal information from the client, I can do a business valuation within a couple of weeks. Normally, business valuation is 10, 15, $20,000 or more. It takes a long time, and again, and it's very expensive. And so I've been using this as a way to help business owners. It's turned out that aside from using it for the succession planning piece, I get a lot of calls now from business owners who say, I'm ready to sell my business. I just need a business valuation. So I basically charge a very nominal fee to do the business valuation so I can get the right numbers. And it's been a really fulfilling, I've learned so much about my own business by looking at other people's tax returns and understanding how it all comes together in somebody's tax return, and then seeing how the results on the platform come out for the client. And it's been very rewarding. So again, there's all kinds of reasons. If a business owner doesn't do business valuation, they're just flying blind. The other neat thing that this service does is it also provides key performance indicators to the client. So in other words, this is all tied into big data. That's how this valuation is generated. Okay. And it's all tied to the business's North American Industrial Code number. So after we get the input done, they can actually see how they stack up against the competition on a local and national level. Okay, on their key performance indicators, debt to equity, inventory turnover, all those really valuable management tools that most closely held businesses are clueless about. So it's a really great service. I really enjoy doing it. A lot of fun. So
Well, that's awesome. And I think business valuations do tie into long-term care planning, that all
yes,
of this is a continuum. So what money myth are you trying to break?
the money myth. This is a great one. And I have to say I didn't make it up. A colleague of mine wrote this up on LinkedIn, and I took it to the next level probably. But he talks about, financial advisors, and this is true whether it's long-term care planning or estate planning. This goes back a long way. It's like, why do wealthy people buy life insurance to pay their estate taxes when all they have to do is write a check or liquidate a building? And the answer is it's because it's more tax efficient. It's more, so it's more, it just makes more sense. And so he talked about the myth of self-funding. And self-funding is a myth because or self-insurance is a myth because ultimately insurance involves the pooling of risk. And when you're taking on the risk without insurance, there is no pooling with anybody else. Okay, so again, insurance implies a risk. Now you may self-fund but don't call it self-insurance. Okay. The other big myth is that people think, well, again, I have enough money to pay for this out of my investments and all that kind of stuff. But most of the time they don't take into account what I refer to as shrinkage. Okay. They have this event, whether it's death or whether it's long-term care need. They don't take into account what if the stock market's down? What if your investments are down? Bad timing. What about the tax implications of liquidating assets, capital gains? Everybody's talking about capital gains again, right? Because the 2017 tax thing is coming up in next year again. So, there's shrinkage, there's tax impacts of liquidation. Though they don't, the other big thing is that when in a long-term care planning scenario, you generally have two spouses, right? One spouse goes down, you need to start liquidating assets or taking retirement income to pay for the sick spouse's care. What does the well spouse live on? So you're just, when you start taking apart the machine that's designed to carry you through retirement, the machine will break down. So some amount of long-term care insurance, or whether it's life, whatever it is, having insurance, sharing that risk with a whole big pool of other people with a tax favored vehicle, life insurance, long-term care insurance, those are all tax-free benefits. And that's a huge, huge benefit to these policies.
Yeah, and I think you point out something that's especially important for people is the timing. You don't know when you're going to have
Correct.
these events, and anything could be happening. If it was a Great Recession and you had to sell your assets, you'd be selling them at a much reduced value, or the market's down
Mm-hmm.
and you're heavily into stocks. So Barry, to start to close out, is what is your go-to resource on money? What is your number one resource? Is it a podcast? Is it a website? Is it a newsletter? What's the one thing you'd recommend to people?
Wow, that's a great question. Again, I mean, as you know, with my radio show, I every week I'm doing something about protection, and I do a ton of research every week on various different topics. I guess again, I find one of the best resources. I think Investopedia does a pretty good job on a lot of stuff. I think definitely stay away from Wikipedia.
Yeah.
But again, I just read a variety. I will say that one of the best resources that I use for multiple topics is I don't want to get it's a website called Real Clear
Okay.
Politics, Real Clear Money, Real Clear Investing, Real Clear Education. They do Real Clear Investigation. I mean, it's so real. If you'll go to realclearpolitics.com is the actual website, but it's not political. It's not all political. and they always give you both sides of an issue, political or otherwise. So I really like that. And again, I when I do a search a lot of times on one of the topics, Investopedia comes up real, especially for consumers. It's understandable, it's clear, it's in bullet points. I love bullet points. People think in bullet points. So yeah, that's probably my go-to stuff and again, obviously I look at the Wall Street Journal and Barron's and all that kind of stuff. I find one of the things, and I find some of the stuff, I won't mention any specific magazines, but a lot of magazines will have stuff written in them that is basically the writer is paying for that space, in one way or the other. It's a sales pitch for that. They're market makers, basically. They're market making articles, and so they're not necessarily research. It's just one-sided. So that's where I generally go.
Well, I think you said something super important at the end, is that people, when you're looking at sources of information, even outside the financial spectrum, is think about, is this biased information?
Yep.
As you point out, is it presenting an argument on both sides? Who's paying for it? That's an important factor. So, if you're watching TikTok and you see that video on Be Your Own Banker, but at the same time that person's trying to sell you whole life insurance, that may not be your best source of information. So,
well, again, I mean, yeah, I every day I have more disdain for social media of all types. I mean, probably one of the best social media sites, and you and I are both use it, is LinkedIn, right? But half the stuff, a high percentage of the stuff is advertised or paid on there. So again, if you want to do your research, and again, if you have a good financial advisor or insurance agent, that's a great source too, because especially somebody who's been in the business for a while, who has a deep understanding of their areas of specialization, but also has a deep understanding of what they don't know and can get you to the right place. Because I think that's a really important thing to consider.
yeah, I love that. I think the smartest people are the ones who can say, this is not something I know.
Right.
Let me find out for you.
Yep.
That's the type of insurance agent or financial advisor you're looking for. Somebody who will reach a point and say, what, I'm going to have to check on this and get back to you, because that's not something I know. Beware the person who has an answer to every single question right off the bat. So,
yep.
That's a great tip. So, Barry, to close out, what is your number one tip on changing the way we think about money?
I think my tip for consumers would be that, listen, at some level, again, we're going back to the same topic. What I find about working with consumers is they read a lot of stuff online, and whether they understand it or they don't understand it, again, the number one tip is to find somebody you trust and you can work with. I mean, really, because ultimately, somebody like me, somebody who's a financial advisor, we're just here to help you. We're your Sherpa, basically. We're here to assist you to sort through the clutter, because there is a lot of clutter out there. So and don't get paralysis through analysis. Okay, if you're dealing with somebody you trust who seems to know what they're talking about, the insurance companies that they're representing are top-rated companies, A-rated companies or better. Here's, if something sounds too good to be true, it probably is. Okay, I mean, again, and we could do a whole show on this, but there is this whole series of life insurance products with no cost benefits. They call them no cost benefits: critical illness, chronic illness, terminal illness. There is no such thing as no cost. Okay, you either pay the cost up front or you're going to pay it in the back. So if it says no cost, that's something to be concerned about. Anything good has a cost.
Yeah, and insurance companies are not nonprofits. They are
Nor
in
should they be.
business
They got
to
to
make
pay.
a profit.
They got to pay. They got to pay their claims, right?
Yeah, and that gets back, I don't want to reopen the whole conversation, but I think that gets back to what we were talking about with the rate increases and everything else, is at the end of the day, insurance companies have to be able to pay claims, as you just point out. And
Right.
so when insurance companies, they are regulated, they do have to have their premium increases approved by various state insurance departments, but they have to make a profit at the end of the day. If they're
Correct.
not able to make a profit, they can't pay their claims
Hmm.
and they can't stay in business. So Barry, where can people learn more about you? Where can they tune into Protecting What Matters?
Well, okay. So, Protecting What Matters is a weekly 90-minute radio show on KPRL in Paso Robles, California. It's live radio, but you can listen in at 12:30 on Tuesday online at kprl.com. But I also take the show at the end of the show and we cut out the commercials and I post it on my website. So you can see all my past shows at www.pwm, like Protecting What Matters, radio, pwmradio.com. And then you can see what else I do on my website. And with all, whether it's long-term care insurance or business valuation or life insurance, I'm all about protecting what matters. And I'm, feel very, blessed that I get to keep doing this for as long as as long as I want to and it can help people. So, okay.
That's awesome. And for everybody watching and listening, as always, there will be links to Barry's website, to the radio show, and everything else. So you can get in touch with Barry. You can tune into the radio show and find him. So, Barry, thanks very much for
Thank
coming on
you.
the Get Ready Money podcast.
Thank you for having me, Tony. It's a pleasure. And I have to get you back on Protecting What Matters. I should have looked up the date. You were on about a month and a half ago or 2 months ago, I think. It was a great show. So you can hear Tony and I banter back and forth about financial literacy. It was great.
Yeah, it's always a lot of fun, Barry, hanging out. We did a lot of work together, but we won't open up that because I don't think that's very interesting for everybody watching and listening. But thank you, everyone, as
Thank you.
always, for tuning in to this episode of the Get Ready Money podcast. If you learned something today to change the way you think about money, please be sure to subscribe and to tell a friend. Until next time, let's change the way we think about money.